Hey there guys, welcome to this month's Technically Speaking, 1st of July, new financial year. I'm here with Mr. Gibbs and Mr. Olarenshaw. What do we got, guys?
How you doing?
Pleasure to be here, gentlemen. Thank you very much. Once a month, Technically Speaking, my favourite time.
Yeah, mine too. Without a doubt. I always look forward to this.
Well, I reckon the excitement levels are blowing me away, so let's actually get into what we're supposed to be talking about. Obviously, an interesting month, pretty reasonable from the results side, but let's talk about some of the big features that we saw through the month. Looking at the technicals, for example, I think one of the headlines there, we saw the 200-day moving average broken, which is significant, particularly when it's broken from the north side to the south side. What's that take on that?
Well, our signal screener went bearish for a little bit and then it's back to bullish now, so I guess that means the market is an uptrend and the money printing presses are going strong.
For those of you who, we might probably have some listeners here that don't know what our signal screener is. It's our proprietary software that Mr. Gibbs designed over here that calls either a bull market or a bear market based on price and volatility. Obviously, you've back tested that system for quite some time now. It's been fairly accurate for us over the period, right?
It is.
It's stewarded the clients really well. We've had a cracking period through this COVID time frame. And I think having that sort of objective measure is really important. When things are binary and they're system based, it does take a lot of the gut feel out of it. And look, talking of gut feel, I have to say, we've seen volatility start to drift down a little bit over the last few weeks, and it just feels like it should be increasing. What's your thoughts on that?
I think there's a real balancing act at the moment between what fiscal stimulus can provide to keep us in check versus what the health crisis is out there. And I think at the moment we're on a tightrope walking along, and we could either fall either side.
Well, my gut feel is that the market should tank, and I think a lot of people feel that way. You look outside and retailers are going under here and there. Hospitality is pretty much dead, apart from a little bit of domestic tourism. The market should be going down. Company earnings are falling through the floor, and yet the market's holding its own. So I guess
it's tricky.
It's an interesting one. You look at the charts, it's a very different story to what's out on the window.
100%. And our whole philosophy has been, to use those 3 points of analysis, technicals, quants, and fundamentals. And there's an enormous disparity between technicals and fundamentals right now. And I know we're in Technically Speaking, so we probably don't need to go too far down that road into fundamentals. But you're quite right. It looks like hell on earth out there economically. Yet this market's still pushing ahead. That quant variable that we look at, volatility, as I say, it's falling, and it doesn't feel like it should be at the moment. And and that to me is something that certainly increases my attention when I'm looking at things, because I like everything to be lined up properly to really confirm trades, and it does feel that there's something adrift there.
Yeah.
I think it's a really tough one, but ultimately you have to draw it back to the objective measure, which is the signal screener. Absolutely. And thus far it's provided us great results. And just looking at our trade results here, we've had 8 winners, 3 losers, so we've won more than twice as many as we've lost, and we've still got 4 active trades running at the moment. Now, obviously we've traded those a number of times. There's about 25 total trades as such in the whole month.
There you go. So we've been active and we're on the right side of the ledger, which is the key thing. I tell you, really looking in on a micro perspective, I think it was last Monday, Tuesday, Wednesday in the market, we had those really long, spindly candles, long wick, long shadow with a very, very small body. And that was 3 consecutive days of that. And that, to me, again, it just looked a little bit wishy-washy in terms of the robustness of the charts. It was followed up on Thursday with a big solid red candle, and followed up with Friday with a solid green candle, and a dominant candle in both cases. So, maybe we are at that flexion point. I think, we've had a little bit of a shake on the market, and look, there've been a lot of new investors join markets through the COVID crisis, and maybe that little bit of shake and nervousness has shaken some of the low-lying fruit out, some of the people that are a bit nervy, that are new to this, and again, creating buying opportunities.
And I think, you have to draw it back to the fact that the market is inherently random, and that was proved by one of these great rumours I know Mr. Gibbs has spoken about, which is the monkey versus the animals.
I can't believe we're bringing this up. So we talked about this morning.
It's crazy, right? So funnily enough, I've done my research. Forbes, Wall Street Journal confirmed both of these have happened over time. So they took 100 months.
What's the story? Because you threw this out this morning when we were having coffee, and you go, that's just got to be one of those urban myths. There can't be any truth to it. What was the actual big headline that we talked about?
Well, there's this competition that gets run in America where they pitch the best analyst against a monkey. And
the best monkey, or just
any monkey?
I don't know if it's one specific monkey, and it's a legendary monkey, but the analyst actually considers it a great privilege to be chosen to go in a competition against the monkey.
And what is it? The
This
stock pick,
competition's
right?
been going on for a long time. Yes, they pick a number of stocks, and then they see who wins. And the monkey has won 80% of the time.
Tell me about it. So I did some more digging into this because I didn't think it could not be real.
You've got too much time.
It could not be real. Well, I'm here early, so I've got plenty of time in the morning. 100 monkeys threw darts, for example, at stock pages, so particular stocks on these stock pages within newspapers. Now, on average, the monkey actually outperformed the index fund manager by 1.7% per year since 1967. So then I dug deeper, and the whole notion of where this came from. It was started in around about 1973, where there was a Princeton University professor named Mr. Burton Malkiel. Now he claimed
research on this. He's on top of this.
I know. He claimed in his best-selling book at the time that the monkey would do just as well as the fund manager. It was in a book called The Random Walk Down Wall Street. He was wrong. The monkey has done better than the average fund manager.
There you go. Technically
Market's
speaking,
pretty
for you,
random.
now we're bringing monkeys on. I think I'm hairy enough to be a monkey, so maybe I could qualify. I don't know.
Well, what it really brought my attention was the fact that, picking stocks is inherently really difficult and it is random. And that's why we've employed such a focus on options, because we have that level of certainty through income generation in an uncertain market.
That's a really interesting point, isn't it? Because if you've got to pick stocks, you're either right or wrong, or they're going to stay in a holding pattern. So, you've got a three-way bet effectively in play there. And as you've said there, statistics have shown that active fund managers have underperformed the index, and a monkey has outperformed that index. So, it's kind of crazy. So, what value add can we bring? The three wise monkeys sitting around the table. I don't know. And I think that's where the use of smart strategy really kicks in. And one of the studies that I followed for a long time, and it's part of the reason why, as a business, we focused on using cash flow on demand as our primary strategy. If you compare the performance of the buy rights index, the covered call index, the XBW, as it is on the Aussie market, and there are equal indices on various markets around the world for the US, compare that to the performance of the XJO over a 10-year period, and the actual outperformance of buy rights versus the XJ over 10 years is astronomical. Now, it's hard for us to talk this, so what I might do, I'll get our AV guys to maybe overlay a chart.
Put a chart on
and
there,
show
sure.
that and actually show that performance.
The difference is crazy.
It is, and it's why I've always gravitated toward this strategy. You've got that downside protection, and sure, in a roaring, bottom left, top right bull market, you'd expect the stock market overall to outperform, but that consistently generated income actually is shown to work really, really well over that 10-year period. So, you've got a fund manager that can't perform in line with the index, you've got a monkey that outperforms the index, or you can use a strategy where you don't have to be great at picking stocks and massively outperform the index. Would explain, I guess, why we use the strategy we do. Very interesting way of getting to that point, but I'll get that chart flashed up so people can see it, because it really is quite hard to get your head around.
And as you told me, options is the thinking man's derivative, and there's for a reason, because you can do some jiggery pokery to manage your risk and also generate income. What are your thoughts, Gibbs?
There's two edges that you're taking advantage of. One is markets go up long term, so you've got that slight bullish bias, which is what a covered call strategy works well on. And two, you're getting time value as well. So you're getting a market performance with slightly less risk, and that's where the outperformance is coming from. It's two edges that...
Can you just explain that again? Because obviously your cerebral genius is beyond most people, certainly mine, especially when I've only had one cup of green tea. But just explain that in a little bit more detail about time and how we sell it as part of the option strategy.
Right, so when you sell an option, you receive time value, and that helps in two ways. First of all, it means you get a little bit more upside potential, but secondly, your downside is also reduced or subsidised.
Gotcha.
And when I say upside potential, you get the time value, your profits are capped when you sell a call, so it's not extra upside potential. If the market pops, there's a bit of an opportunity loss there.
I guess the key thing, none of us are really that new to markets, and when you really explore it, it's all good and well talking about the upside, and if this were a sales presentation, that's pretty much all people want to listen to. But the reality is, with a group, a family, a community of traders, it's not just about the upside, it is managing the downside. And once the downside's handled, the upside will take care of itself. It shouldn't be the other way around. And that premium income, if we look at some of the trades this month, particularly maybe a couple of losing trades, what we've done there is we've been able to cap our losses by reducing them based on the premium that we've received, so it's softened the downside.
Mhm.
We've also rolled down to generate more premium to soften that downside blow. Plus we've used puts in there. So there are two different ways where options have really helped our clients not feel the pain of a losing trade to any extent that a normal share investor would, by a combination of that premium income, the roll down for more premium income, and the use of the put option there for protection. And really, in essence, that's what we do, and that's why we do what we do.
It probably is like
right, yeah.
40 to 50% reduction in what our total loss would have been over the life of that trade. So the use of options was really quite smart because you're able to do so much jiggery pokery in there to do things like
Yeah,
that.
you get that extra flexibility. So as you already said, rolling down, we get some more time value coming in, which again subsidises any potential loss. It also means you can collect a premium if the market turns and goes back up. So it's very effective what you can do with options, and getting that time value in the door does help returns a lot.
Well, and again, the buy right index really reflects that over the long term. I mean, people go, oh, you've picked a period. Whenever we talk about a period of time, we had the onslaught of comments a couple of weeks ago when we talked about long-term investing hasn't worked for a number of stocks. And you pick the time frame, it was 20 years. I mean, how much time do you give something? 20 years is long enough to see if it's going to work or not. 10 years is a more than reasonable time frame, I think, to consider.
Totally.
It shows itself head and shoulders above that. So if we look back at where we see the markets right now, obviously we've had this little bit of a shakeout, a little bit of nervousness. Where next? Get the crystal ball out. What do you got for us?
Well, I mean, as I said before, my gut feel is the market's fully priced and it should go down, but I think we can use the signal screener for timing. I mean, that can turn around any time and go into down territory or red territory, but it will mark the beginning of a downtrend if we get one. The question is, when do we get it? Is the market going to go up for the next month first before it goes down? We don't really know that. Even if your gut feel says down, the advantage of using a system is that it's objective and it keeps you on the right side of the general movement. And the other advantage of the signal screener is it will keep you in the market when it's going up. So you're letting your profits run, but because it flips around fairly quickly when markets turn, it reduces that downside as well. So even if the market is random, what you're doing is you're still collecting the uptrends, but you're cutting out your trades on the downtrends, which is really reducing your risk.
And that's what this game's all about, keeping yourself alive in the tricky times and capitalising on when it's pretty good. Look, I mean, we've had Aurora, there's no question about that, and I think as we talked of in the previous, technically speaking, my view is I think we'll see the market higher at the end of the year than where it is now. As to how we get there, there's no one really knows what that pathway looks like, and some volatility really would be expected given the news flow that's outside. And I think, as we see what we've got to grapple with Corona Wave 2, and without again diving too much into fundamentals, one of the things I've noticed quite recently is that sort of saber rattling from China has gone very quiet over the last week or so in the media. It was pretty big talk, a couple of weeks ago. There's still the conflict on the border with India and various other things going on there. But it's kind of back in check a little bit. Perhaps they're grappling now with their own coronavirus all over China rather than just concentrated in Wuhan. And this is one of those big unknowns that are out there. And I think, from experience, we go back through the chronology of different corrections that some of us or all of us have been party to through our trading career. We've had this one, we had the GFC, we had the dot-com boom and bust, the Asian currency crisis in '98, and you and I were across markets throughout those timeframes. This one's a little different because it's truly global and it's also a big unknown. And what I've found myself doing, and I was just going through my journal looking at the trading month, and that is when times get uncertain, the certainty I get is going back to my tried and tested honey holes, not in terms of stocks, but in terms of strategies. And once again, that sort of squares the circle on why we're back to covered calls, because rain, hail or shine, they're a strategy that typically deliver very, very well. And yes, we do move into other areas in the market with V12 and the work you're doing with our advanced options group. And again, that's been a nicely lucrative strategy for people playing at that level. But it's a niche. It's not a product for everybody. It's
hard to learn. It takes a while. You can manage the downside risk. In fact, you can put strategies that have no downside risk. But usually there's risk on one end. You can either choose whether you want risk on the upside or the downside. So they're good strategies. But the covered call's a nice simple one, and it's one of the best.
And it's continuing to pay. So you get exercise, take on the stock, write the call, wash and repeat,
Having good fun, to be honest, gentlemen. It's been a great time.
As they say, monkey see, monkey do.
There you go.
How about that? That's not a bad dad joke, was it? And saving that one up.
My dad's taught me that plenty of times. Nothing new there.
There we go. Anything else to wrap us up for today? I mean, that's us at the end of June. It's the end of the financial year. A bit of window dressing in the market, maybe from some of the fund managers as they try and rescue some form of performance figure for the quarter. I see AMP, have sold out their life management business for about $3 billion. That might help recapitalise them, but don't see any great shakes coming out of that business. The window dressing at the end of the quarter wasn't probably what we would normally see because we've had such a strong recovery from that sort of COVID low. And it'll be very, very interesting to see what this new financial year brings. It's certainly a bit tentative on the open this morning, a little bit of push here and there.
Non-farm payroll out tonight, I think.
Yeah, would be
holiday in the US.
Yeah, Friday's 4th of July on Friday, isn't it?
Yeah, it's off. It's been up the last few times. We've had better than expected results on that.
Well, this is an interesting one. Okay, I'm sorry to catch you off guard with this. I'm just thinking. So we're just about to. We shouldn't. I'm not going to talk about it anyway. I know we shouldn't talk about it, but we're just about to roll out the launch of MyTradingAdvisor, which is a project that we've sort of been working, behind the curtain on for the last few months. And in doing that, one of the tools, I'm putting on the spot with this, Gibbs, you said it yourself already, one of the tools that we've talked about, and I hate to use gambling as a term, but the form guide, some of the things that we look at. Yeah. So one of the things that you've built is this statistical and quantitative analysis machine, let's call it that for the moment, where you look at things like, okay, if it's a non-farm payroll figure and the day before it was an up day, the probability of the next day being up or down outside the opening range is like 68% or 32%.
Mm-hmm.
I mean,
scarily accurate.
It is, isn't it? Without giving the game away, tell us a bit about the form guide, man. I'm interested to hear your take on it, because as soon as you explained it to me, you reeled me in a treat, and when you look at the hard numbers that you've generated out of it, I mean, man, it's a huge competitive advantage for some of our clients that will have access to it.
We're calling it the form guide for a reason, and that is we're getting the form on the market. So we're looking at a huge range of things. We're looking at all the technical indicators, seeing where they're positioned and seeing if there's a bias for tomorrow. We're looking at the economic news, seeing if there's a bias for that particular announcement. And we're looking at a whole raft of other things like days of the week, days of the month, where we are in the quarter, where we are in the year.
It's crazy.
And you just get this great big table, and if a whole lot of things start to join up and you start to get a positive bias across the whole raft of things, then you might have a reasonable chance of either a long or a short bias over the next 24 hours.
So this is more for people who are looking in the real short-term stuff, in the day trading space?
It's only for one day. We're just doing the form for one day, which is hard. Day trading is hard, but...
Well, it's even harder without that competitive advantage of knowing what the form is, I suppose.
It's crazy how your brain is able to compile all of this information and make it into one easy, this percent. Crazy.
You're just looking at the odds and looking at a few colours. It's nothing.
He's too modest.
Yeah, look, I think you're playing this one down, to be honest. I saw the whiteboard in your office, and it was like walking into the mad professors. It's like just shut the door and leave you to it. But I thought it was really interesting to see what you've done, because you sort of think about it in farming sort of terminology. You got a whole bunch of animals out in the paddock, a whole herd of cattle, and you're narrowing them down into the yards to make it smaller and smaller, getting them in the crusher and on one at a time in rows of 13. And that whole approach to trading, by being able to take this macro view of maybe 20 or 30 economic factors, the day of the week, how far into the month. I didn't look at the tidal cycle, lunar cycle on there, but I'm sure you could factor that.
What shoes you're wearing.
We don't look at lunar cycles.
No, that's not. Well, we could maybe we could.
Sure, we can add that in. Bring in the
astrological trader. That could be the good thing, couldn't it? What do you reckon?
We're Saturn in relation to the sun, aren't they?
And out of that, be able to sort of spell out, a reasonable number to say the probability of it being an up day today is 75%. So if you're a day trader, that's where you go long, or indeed short if it's the other way. That fascinates me, and I know that a lot of our listeners and viewers are going to sort of see that as we launch MyTradingAdvisor fairly shortly. And let's not do it a disservice. I mean, the idea of a form guide, and I know that brings up a whole bunch of connotations in the gambling space, is effectively what it is. I mean, if you go to the track, you can see what barrier the horse is drawn, what weight it's carrying, how it goes, whether the going is heavy or whether it's firm. The last 5 places that the horse is finished over that distance, or what distance it's won at, and so on and so forth. And when you put all that into a model, I guess it really can help you. And we're doing the same thing, I guess, on the trading side.
So there's one very important difference. the TAB takes 30% of your pot on the racetrack. Whereas, the market's 50-50, so nobody's taking too much out of the pot, which means you can get the odds a bit more in your favour compared to the track. If it wasn't for that, if it was just say all the money that all the punters put in for a horse race and then you had the form, maybe you could get some sort of an edge.
I suppose on that too, if it's at the tracks, it's binary. If you lose all your stake. The money's gone. Whereas at least in the trade, you've got your risk management in play and you're going to take some bark off, but it's not risking all the capital. Interesting. More to come on that, but that really is technically speaking at your level, which is significantly above mine and mortals like myself, and I'm not going to put you in that camp because you're pretty smart too. But for us mere mortals, and maybe some of the listeners are in the same camp as me, it's like, well, can you really do all that? And it's a great model, and I can't wait to see it roll out. And for our clients, more importantly, to better share in the spoils, the profits that come from that. The stuff you've done on V12 has been fantastic for our clients.
We'll help with V12s. We'll have a bias for the day, so we'll know if we're legging in or legging out. We know which trade to put on first, that sort of thing. I think it'll be really useful.
And for a lot of people, what is V12? Look, that's not an entry level strategy. That's one we'll keep for another time. But here we are. That's the end of the month. It's been an interesting run through. It's been a great financial year. So it's been a great month trading as well, and more of it to come. But that signal screener once again has kept us safe, which is really what it's all about. So great work on not only developing that, but the daily application of it and the structure it provides, so we stop listening to our gut feel and the experience that we believe we've got in markets and really look at the hard and facts.
Objectivity, that's the key, isn't it?
That's the key.
And that's why it's technically speaking. There's no fundamentals, there's no personal view, it's just what the charts and the numbers actually say. And that objectivity, I think, is really going to serve our clients well over the next 6 months of this year.
There you go.
Yeah,
there you go.
Agreed.
Anything else? I can't believe the monkey story, and I can't believe you actually get it into this.
Check Wall Street Journal or Forbes if you don't believe me, but yeah, it's true.
So if they've been running it for a while, is it like a second generation? Is it like do they have two monkeys and they breed and the real smart ones? How does it work?
Because the monkeys are so smart, they've sort of had to genetically separate a really good bunch and a bad bunch, and the bad bunch is still outperforming. It's crazy.
So like the
it's like breeding horses.
Third generation of monkeys is still outperforming, learned from second and first generation.
Yeah,
doing well.
You can pass those genetics down.
So what happens to the really smart monkeys? Where do they go?
They get sold for millions of dollars. They're pretty sure they hide on Wall Street. They wear gold watches and shirts.
So
you walk into the office in a gold cuff shirt. Gotta love that. Well,
we shouldn't get the monkey off our back. We should keep it firmly on our back.
Oh, that's another dad joke. That's pretty good. You see, you're out of your depth. You don't have kids.
I think we have to wrap this up now. It's getting too far.
Easy. Great chatting again, guys, and I hope the viewers enjoyed it. This is technically speaking a bit of fun this morning, but market should be fun, and making money certainly is. So we look forward to chatting further. Thanks for joining us.
Thanks, gentlemen.
Cheers, guys.